Hello everybody and welcome to my pre-class lecture on Chapter 10 Long-Term Liabilities, and specifically in this lecture we're going to be focusing on bonds. So the purpose of this lecture is really to kind of give you the information condensed that you're going to need to know and that I'm going to expect you to know before we start our class. So again, we're working through our tour of the balance sheet. We covered assets before the last exam, and now we're on to liabilities. Last week we talked about current liabilities in Chapter 9. Now we're moving on to long-term liabilities in Chapter 10. So these are liabilities that are going to stretch for more than 1 year. In Chapter 10, I'm going to really just be focusing on two main types of long-term liabilities: bonds and installment notes payable. But again, for this lecture, we're just going to be focusing on bonds. So my agenda for this lecture is really to cover the main concept of bonds payable. So what are bonds to begin with? I'm sure you guys have all heard that term, stocks and bonds. But you may not know exactly what a bond means. So we'll talk about that in this lecture. We're going to talk about the characteristics of bonds. We're going to talk about the journal entry, so how we actually record bonds. And we're going to talk about the phases of a loan and how we record the journal entries for each of those phases. The first phase, of course, is issuance. That's when you receive the loan. We'll talk about what happens while we're borrowing the money during that long-term period of time. And then we'll talk about how we record the maturity, or as we learned in Chapter 9, maturity means the end of that note when it's all grown up and is ready to be paid off. And associated with bonds, we're also going to talk about the concept of time value of money. Now, I'm not going to talk about this in this lecture, but I'm going to talk about it in class. But I just wanted to kind of prepare you that this is an important concept that you're going to need not just for this class, but it's going to come into play again in Accounting 1B, and it's also going to come into play a lot in your finance classes. So, I want to make sure that you get kind of a good background of time value of money, and that's what I want to spend the majority of our class time working on, is this concept of time value of money, because it is quite complex, and that's why I want to make sure that you have the basics of bonds down before you come to class, so then when you come to class, we can focus on the more complex issues, which is the time value of money. Okay, so here we go. We've got a business problem. Okay, our business problem is this. Wells Corporation needs to borrow a large sum of money to build a new factory. So they go to their bank to ask for a loan. But the bank says, no, we can't loan you that much money. Right? It's a really big loan to be able to build a factory. So the bank isn't willing to take that risk of loaning that much money to Wells Corporation. So what should Wells do? Okay, keep in mind, they need a lot of money, a very large sum, and one single bank is not willing to take on the risk of that loan. Well, what Wells Corporation can do to solve this problem is, if one lender cannot loan them a large sum of money, what they can do is take that large sum of money and split it up into a lot of small bits of money and ask many different lenders to lend them that money. And that is essentially what a bond payable is. Okay, it's taking a large loan, dividing it up into small pieces, and asking several different creditors to loan you that large sum of money. Kind of makes sense, right? It's not a bad idea. So let's talk more about, now that we know the concept of what a bond is, let's talk about the characteristics. So first of all, one characteristic of bonds is the amount. It usually has a large total principal amount. Okay, and that's the whole reason why we need the bond, is because it's such a huge amount that one creditor is not willing to take on all of that risk. So they're breaking it down into small amounts, and each of these small amounts is called a bond. So in total, the whole loan is called bonds payable. Okay. Now, those small bonds have what we call a face value or par value of a smaller amount that's going to be usually like $1,000 or $5,000. So this is kind of what a bond looks like. I know technically back in the day they used to have bond certificates, and the bond certificate would have certain information. It would say, Wells Corporation promises to pay a par value of $1,000. So in this case, each individual bond of this large loan is $1,000. And it's going to tell you also the terms of the bond. So it's going to say the maturity date, in this case 5 years, and then it's going to have an interest rate, in this case 6%, and it says here paid semi-annually, and I'll explain to you in a minute what that means. But the point is this: each individual lender or creditor, or what we would say call in this case a bond holder, meaning they hold this certificate, they hold this promise from Wells that Wells is going to pay them back. But their piece that they're going to get paid back is just the par value or the face value, which is that smaller chunk, in this case $1,000. And there's, of course, going to be several of these certificates, and each different bondholder is going to hold that certificate and get that promise. So another characteristic then is that there are many lenders or creditors, or like I said, we call them bondholders. And then let's talk about the repayment structure of this loan. Okay, the way that the repayment of a bond works is the principal amount, or the amount that's being borrowed, is paid in a lump sum at the end of the loan period. Okay? The whole thing is going to be repaid at the end. But because the loan is for such a long period of time, in this case 5 years, and some bonds are even longer than that, 10 or 20 years, the thought is, look, if you're borrowing my money for that long of a period of time, for 5 years or 10 years or 15 or 20 years, I can't go without my money for that long. You're using my money, meaning I can't use my money. So because of that, I want to see my interest or the cost of borrowing money. I want to get that semi-annually or every 6 months. Okay? And the interest is going to be calculated using what we call the contract rate, which is the stated rate on the bond certificate. Okay, so in this case, the stated rate on the bond certificate is 6%, so we call that the contract rate. And again, it's paid semi-annually. So let me show you what this payment structure looks like. Okay, now in Chapter 9, we learned about short-term notes payable. And the examples we were looking at were all for less than a year. And when the loan is less than a year, the loan, if this is our timeline of our loan, the loan starts here and we repay the principal and the interest all at the end of the loan period. Okay? And that's because it's a short amount of time. But with a bond payable, because it's long term, you see our timeline is much, much, much longer. And you would see how long we have to wait to be able to get our principal back, to be able to get our loan back. So the lenders or the bondholders are saying, look, if I have to wait this long to be repaid, I don't want to wait that long for my interest too. I want to get my interest more often than that. So that's why we're going to be paying interest every 6 months throughout the life of the loan. So you can kind of see the interest is being paid periodically throughout the period of the loan. The principal is going to be paid at the end. Okay? And this type of bond is usually used by the government a lot and also by very large corporations. Smaller companies really would not get into bonds like this, but it's usually most often the government that has bonds like this because they have really large projects. Like we have to build a freeway or something like that they need a lot of money for. You'll see school bonds too. Like, oh, you know what, we're building a new school. Well, if you need to build a new school, that takes a lot of money. So what they do is they issue bonds. So people can, the individual citizens can lend the funds to the government, and then the government will pay them back using this structure. All right, so now let's get into journal entries. And as I mentioned, there are really 3 phases of the life of the bond. So I'll go back here. The 3 phases, of course, are the issuance, the beginning of the bond, then throughout the bond, and then at the end, the maturity. Okay, so if we start here at the issuance of the bond, it says on January 1st, 2015, Wells Corporation issues $1 million of 6% 5-year bonds payable. That means the total amount, if you add all the bonds together, it comes out to $1 million. And remember, they're all in chunks of 1,000. And it's 6% interest for a 5-year period of time. Interest is payable semi-annually on June 30th and December 31st. Assume the bonds are sold at par value. And we're going to talk more about this term, assume the bonds are sold at par value. We'll talk about that in class. But for now, just that's all you need to know is what par value is. All right, so we record the issuance of the bond. And that essentially means when the loan begins, the bondholders or creditors, all of these individuals, give their $1,000 chunks of money to Wells Corporation. And in exchange, Wells Corporation gives them this promise, this bond certificate or this bond payable, a promise that they will pay them in the future. Okay, so our journal entry to record that on January 1st, 2015 is we're going to debit cash because our cash is increasing. We're getting $1 million. And we're going to credit our liability called bonds payable because we have to we are now giving that promise that we are going to repay this bond back. So this is our liability. Okay, the next phase of the life cycle of our bond is throughout the period of the bond. And I'm going to take this moment to pause right here because I'm almost out of time for this first chunk of the video, and I will continue on the next video.